Welcome to Fintech Confidential, bringing you the people, tech, and companies that change how you pay and get paid. We're here to review the things that moved Web3 in October 2025. Now, this month was wild.
It's always 2 steps forward, 1 step back.
An accidental, yes, I said accidental, $300 trillion minting error.
A California federal district court judge ruled that the board NFTs are not securities.
They want the benefits of the blockchain, but they don't want the price volatility.
It's the Prince Group, which is a major pig butchering operation.
October closed down.
That's the middle path that's not getting talked about so much because maybe it's not worthy of all the headlines. Stablecoins now comprise 30% of all on-chain crypto transaction volume.
We still haven't figured out how we're going to make enough money to pay for all of that. So if we can just slow it down.
There's only one G7 nation on there. That's the US.
It's just been going crazy. I mean, it hit $307 billion with estimated annual transfer volume reaching $2.6 trillion.
BPI argues that the applicants are engaging activities that, quote, closely mirror core banking functions.
Why are we not seeing Uptober and we're seeing
Red October?
Definitely at a neck-breaking pace. The question that everybody was asking this month was, you're building a fintech product. You want to offer digital assets, but wallets? That's the hard part. Security, compliance, key orchestration, blockchain integration. That's why fintechs, payment platforms, and custodians choose Defense. They provide wallets as a service that's API first, multi-chain by design, and secured within PC. No single point of failure. So you can launch across over 50 blockchains, automate policy controls, and stay audit ready without managing private keys. Stripe's Bridge powers crypto payments through Defense. MoonPay scales wallets securely with Defense. Sphere grew without compromising on control or compliance. Even major FIs like Fidelity, ABN AMRO, as well as custodians like Zodia and Tungsten trust Defense to power their on-chain infrastructure. Developer ready, compliance approved, production grade from day one. If you're building in payments, exchanges, OTC desks, market makers, or DeFi, Defense wallets work the way you need them to. Request your demo at fintechconfidential.com/DFNS. Defense, secure wallets built right. Welcome to Web3 with FTC, powered by Fintech Confidential. If you're asking how blockchain, crypto, AI, or even quantum computing fits into your business strategy, this is built for you. We talk with the builders, decision makers who are doing the work, whether you're a founder, an executive, or just trying to stay ahead. This is where you get insights to the shifts that matter. So let's go ahead and get started. I'm your host, Ted Huff, founder of Fintech Confidential and the CEO of Fintech advisory firm Voalyre. And joining me today is confidential informant Rob Musiala, a partner at Baker Hostetler, and he co-leads their Web3 practice, along with the blog, The Blockchain Monitor. You can go and check it out over at www.theblockchainmonitor.com. Rob, welcome back, man.
Thanks for having me on the show, Ted.
We're here to review the things that moved Web3 in October 2025. Now, this month was wild. I mean, we saw Bitcoin's worst October since 2015, and the flash crash that wiped out over $19 billion in leveraged positions, major stablecoin announcements from Western Union and Tether, and an accidental, yes, I said accidental, $300 trillion minting error. We're going to go ahead and cover regulatory battleground over OCC charters and where traditional banks are trying to block crypto companies. We're going to dive into the stablecoin market that's now processing more transaction volume than major card networks. And we'll also look at how the Genius Act continues to reshape the entire industry. I want to kick off the lightning round with what I saw happening in the major crypto markets this month. And of course, you know, I've got to start off with the good old Bitcoin. It peaked at $126,200 on October 6th. And that was this third straight month where it closed above $100,000. And everybody is still celebrating, though the ugly lights came on, the music got turned off really fast. I mean, the administration announced tariffs on October 10th, and that made the price just crash by 18%, sometimes more, depending on which one you were looking at. That made prices crash over 18% down to 104,782. Now, this wiped out over $19 billion in leveraged positions across 1.6 million traders. Not only that, but October closed down 4 to 5%, near $110,000. That's what turned what usually is a bullish month into the worst October since 2025. On-chain volume hit $2.3 trillion, the highest volume since November of 2024. And the volatility, well, as we've talked about multiple times in this space, it can go crazy. And it spiked from 40% to 60% during that slide. Now, we can't leave out Ethereum either because it dropped 10% in October to close nearly at $3,856 after hitting its all-time high of $4,953 back in August. The ETH fell briefly close to the $3,000 mark and erased almost all of the 2025 gains. The Fusaka upgrade is locked in for December 3rd, so we'll see how that went and how that will lower the roll-up cost and increase node bandwidth. On top of that, we've got spot ETFs that pulled in $668 million for October, despite those 5 days where the outflowing totals exceeded $219 million. It leads us right into a November that is going to be extremely interesting to watch. Now, XRP, that's another one that we've paid a lot of attention to. They had a lot of interesting developments. I think the futures options that got launched on October 14th and 15th, it really was making some waves. Not only that, but Ripple announced a pilot at Swell 2025, which is their conference in New York City, with a major global payments network and a U.S. regulated bank to settle credit card transactions using the RLUSD stablecoin on the XRP ledger. This in itself marks one of the first times that a regulated bank will settle fiat payments using a regulated stablecoin on a public blockchain. With that announcement, I bet you're super surprised about this, Rob, that XRP bounced over 4% once that announcement happened. The year end, we're going to really see some stuff happen once we find out what happens with these pending ETF approvals. And last but not least, in the market, we've got to talk about meme coins. I mean, they got hammered. 60 to 80% drop in those. Doge still held its lead. Shiba Inu trailed at about $6.1 billion. You've got Pepe that dropped significantly to a $2.97 billion cap, down 65% from its top 50 status with $500 million in daily volumes. We talk about these three all the time, but we've had some newcomers that really surged. MiniU surged to 203% to $56 million market cap. Burned FI spiked to 2,385% in 1 day to $73.74. And Memecore jumped 230% to become the fourth ranked meme coin. Rob, as you can hear, I mean, so much has been going on in that space with the coins. What's going on in the technology that sits underneath of all of this?
A couple notable developments in layer 1 and layer 2 networks. So first off, the YLDS stablecoin was launched on a new public blockchain, the SUI layer 1 blockchain. YLDS is a yield-bearing stablecoin issued by a subsidiary of Figure Technology Solutions, Inc., which recently went public through an IPO. And YLDS was previously available only on the Provenance blockchain, so it has now moved to a second layer 2 blockchain. Another update, Ironlight Markets received FINRA approval to launch an alternative trading system, or ATS, that will support the issuance and trading of both traditional securities and tokenized securities. An ATS, Ted, is a special type of broker dealer. And in the US, there are only about a dozen or so ATS platforms that are able to facilitate the issuance and trading of tokenized securities in full compliance with SEC regulations. And Iron Light Markets is now the latest to join that group. So that's a significant update. And then lastly, we had multiple reports released with some really interesting Q3 data on the Bitcoin, the Ethereum, and the Solana networks in particular. And we'll dive deeper into that later in the podcast.
The stablecoin market has just been going crazy. I mean, it hit $307 billion with an estimated annual transfer volume reaching $2.6 trillion. Now, that's nearly 2.5 times combined the purchased volume from the two world's largest US-based card networks. And USDT, it still holds 60% of the market share at $150 billion. USDC sits at $67 billion, and Ripple's RLUSD crossed $1 billion after a 1,278% year-to-date growth. Not only that, but Western Union decided to jump into the stablecoin pool as well. They have launched a federally regulated stablecoin on Solana. They're targeting the first half of 2026 for launch. And the idea is that the stablecoin will launch and integrate with the Western Union's over 550,000 agent locations across 150 plus countries, combining not only the federal oversight with Solana's high throughput blockchain. One of the things I thought was really interesting in this space is that Zero Hash is rumored to be acquired by a top 3 global payments network. I'll let you all guess who that is. This crypto infrastructure firm is in their late stage talks to be acquired for almost $2 billion, or rumored $2 billion. The acquisition is going to provide access to regulated infrastructure supporting stablecoin payments, crypto trading, custody, and other tokenized assets across multiple states in the US. We mentioned this in our September review. Tether continues to move forward with their discussions about their plans to push a new USAT stablecoin. They've made an announcement that they plan on launching in December 2025, along with the former White House official Beau Hines as the CEO. USAT features exclusively reserves that are compliant with the Genius Act, while USDT continues operating global as a foreign stablecoin issuer. The U.S. Central Bank Governor Christopher Waller unveiled a proposal for limited purpose, or as they're called, skinny payment accounts, allowing for eligible stablecoin issuers to access the Fed rails like Fedwire, FedNow directly. This proposal, it aims to promote competition and speed in the payment system while maintaining eligibility requirements and imposing balance caps. I do want to talk about the fact that we've had all these US dollar-based stablecoins being announced, but Japan has launched their very first yen-peg stablecoin. This here is backed by bank deposits, the Japanese government, across Ethereum, Polygon, and Avalanche. And this is because the yen status as the third most traded global currency will give this coin very unique advantages. And they are targeting 10 trillion yen circulation within the next 3 years, which just kind of blows my mind that they're at that point. But not everything is sunshine and rainbows. Paxos minted accidentally over $300 trillion worth of PYUSD during an internal transfer, more than twice the global GDP. And this error was corrected within about 20 minutes, though it does highlight the risks that we'll talk about later of central control, limitations of stablecoin, and the regulation that is needed to be for that. Before we dive in and start talking about the regulatory environment, the IMF warned that the $305 billion stablecoin market could threaten traditional lending and monetary policy despite being backed by liquid assets. U.S. Central Bank Governor Michael Barr countered that the Genius Act's tight control over reserve assets could enhance stablecoin stability and make them more viable as a long-term payment instrument. What else did we see happen in the regulatory and legislative areas?
A California federal district court judge ruled that the board NFTs are not securities. The federal district court judge dismissed a proposed securities class action against the creator of the Bored Ape non-fungible token collection, finding that the NFT sales failed key prongs of the Supreme Court's Howey test for an investment contract and therefore did not constitute securities transactions. So that's a major development from the courts. Second up, 3 more digital asset focused companies filed applications with the OCC for national trust bank charters. These include major crypto exchange Crypto.com, Connectia Trust NA, which is an affiliate of a major Japanese electronics company, and Bridge, which is an affiliate of a major US payments company. Third, the Bank Policy Institute, banking advocacy organization, published a series of letters specifically urging the SEC to reject the pending national trust charter applications of 5 major digital asset companies, including Ripple, Circle, Paxos, National Digital Trust Company, and Wise. So while we've got 3 new charters filed, we've got resistance against those charters from the BPI. Next, the first deadline for comments from the Genius Act passed. And so we've had companies from various corners of the digital asset and financial services market publishing their first round of comments on the Genius Act, which focused on illicit activity. Next up, FinTrack, Canada's AML regulator, imposed a $176 million fine against the Cryptomis exchange for various AML violations. And lastly, the U.S. Department of Justice filed its largest ever forfeiture action against approximately $15 billion in Bitcoin, all related to a DOJ action against the Prince Group, which is a major global pig butchering operation. The Prince Group, according to the DOJ press release, is a Cambodia-based business conglomerate that operates forced labor compounds where individuals are held against their will to engage in crypto fraud schemes, which are known as pig butchering scams.
And we thought that was only in movies.
No, it is real. Now a $15 billion forfeiture action related to that. So those are some of the key regulatory updates from the past month.
October did give us a lot to unpack. The question that everybody was asking this month was, why are we not seeing Uptober and we're seeing Red October instead? And the data tells us it definitely was Red October. It wasn't an Uptober like what they were hoping for, especially for traditional crypto assets. Worst for Bitcoin, tariff announcements, $19 billion wiped out. What are some of the things that you're hearing about how all of that happened in that short period of time?
It's always fun to speculate as to why some of these things happen. And having worked in this market for over 12 years now, it's always 2 steps forward, 1 step back. We definitely saw an example of that 1 step back in terms of the price. I can speculate that because the price has been relatively high and strong, there are rumors that more and more so-called Bitcoin whales have been cashing out and liquidating Bitcoin that they've been holding on to for a long time, essentially trying to liquidate a percentage of their large holdings. In the event that that's actually true, that would probably certainly have some downward pressure on the price. I think that the broader economic outlook potentially has had effects on the price. And if that's the case, what that shows to me is that Bitcoin continues to become part of the larger global financial system. It's tied to other traditional financial instruments. It can have price swings that are tied to events that also trigger price swings in other traditional financial instruments. Despite the bad news with respect to the Bitcoin price, the larger digital asset market still appears very strong. And I think that is evidenced by some of the other things we'll talk about, mergers and acquisition, stablecoin activity, and others. So those are my brief comments on the price for the month.
These aren't like crypto native companies or digital asset native companies buying other digital asset native companies. You've got major card networks, you've got major money movement platforms, you've got financial institutions, you've got all these different outside players that are just acquiring this digital asset infrastructure. Definitely at a neck breaking pace that these guys are being gobbled up.
It's a sign that the digital asset market is just becoming more and more entwined and a part of the traditional financial services sector. I think certainly for the time being, and it will always be its own niche, but it's a niche that is becoming more and more connected to the traditional financial system. And I think that's one takeaway we can glean from all the M&A activity that has continued for the last couple months now.
The area that just seems to be this rocket ship that doesn't look like it's going to run out of fuel anytime soon is what we're calling stablecoins. Why do I believe this happening? When you got Bitcoin and Ethereum swinging and the volatility going from 40 to 60%, that's a 20% swing. I think this gives the benefits of the digital asset like a Bitcoin to businesses and consumers who really need that stability. They want the benefits of the blockchain. They want the instant settlement. They want the low fees. They want the 24/7 availability, but they don't want the price volatility. It's been really crazy around that.
When you have whales that are liquidating Bitcoin, Ethereum, other digital assets, a lot of the time they're actually moving it into stablecoin because it's operationally easier. And so that, of course, while may drive downward pressure on the price of whatever digital asset is being liquidated, can actually end up strengthening the stablecoin market because you've got more capital invested in stablecoins.
Support provided by Skyflow. What if you could build fast but not break privacy? What if you could ensure data privacy, governance, and compliance with just a few API calls? What if you could worry less about PCI requirements while actually improving privacy and security? How much more time would your team have to truly innovate? How much faster could you build and ship new features? How much more powerful could your app be? Skyflow is a zero-trust data privacy vault delivered as an API. Skyflow's radically simple design lets you collect, secure, and tokenize personal information like card data and payment details. And with built-in features like encrypted data analysis and sharing, anonymization, and advanced governance, your days of choosing between data security and data usability are over. Whether you're just concerned with PCI compliance or need to go further to include CCPA, GDPR, SOC 2, and beyond, Skyflow has you covered. What if you could build fast but not break privacy? With Skyflow, you can. Visit skyflowsecure.com today to learn how.
Stablecoins are becoming their own niche of this marketplace, so much so that, I've heard some folks refer to stablecoins as not really crypto. While they rely on blockchain, so different from kind of the fundamental concepts that underpin Bitcoin and similar cryptocurrencies similar to Bitcoin, that they really are becoming more and more just part of the traditional financial system. In other words, putting a US dollar on the payment rail of the Ethereum network or another blockchain network. I don't think we're quite there yet, but I think that over time, 5-10 years from now, it may be more common to refer to stablecoins in that way.
That is why there was such a calling to a CBDC or the centralized bank digital currency. We still have a number of countries that are working towards it. And the idea of having that digitized currency is a super important piece, and it does give all the benefits. This has started a little bit of a battleground between distributed ledger technology like a stablecoin and the traditional finance ecosystem. And so much so, as you mentioned in the lightning round, there are OCC charter applications flying everywhere. There were so many backlogs, the OCC on digital asset related items in the hundreds at that time. I know we're probably 10 OCC charter applications so far.
Somewhere around that number, yeah. Digital asset companies seeking OCC National Trust Charter applications.
I mean, we've got Ripple, Circle, Paxos that applied for the National Trust Charters. Not surprised, but I do find it interesting that the BPI or the Bank Policy Institute has been pushing back. I want you to kind of explain to us the approach that they've taken. How are they doing that?
What's most interesting is that instead of publishing one letter and issuing one letter to the OCC explaining why they had issues with these OCC National Trust Charter applications by digital asset firms, instead of publishing one letter, they actually published, I believe it was 5 separate letters, each letter individually addressing a specific OCC Trust Charter applicant and individually explaining why that specific application should be denied. That shows that there's pretty significant level of effort here by the Bank Policy Institute. And I think that really shows that they are making a calculated decision here to try to use the OCC application process as kind of a new battleground to protect the market share of the banking sector. Some of the reasons that BPI gives in these letters for why they believe these applications should be disapproved. I'll just give a couple quotes here. One of the quotes, one of the letters says that the applications reflect a growing trend of non-bank financial companies seeking limited purpose national trust bank charters, despite not planning to operate genuine trust companies. In other words, what the BPI seems to be saying is that in their view, these companies that are seeking these national trust bank charters are actually planning to perform activities that go outside the remit of what a national trust bank charter allows. And the implication there is that in BPI's view, the activities are moving closer toward a full service national bank charter, which is harder to achieve and which, of course, allows more activities. One of the questions fundamentally being posed is, what are the digital asset market activities that you can conduct under a national trust bank charter, and which ones can you not conduct under that charter, but instead do you need a full service national bank charter in order to engage in? A couple more quotes from one of the letters. BPI argues that the applicants are engaging in activities that, quote, closely mirror core banking functions, such as managing stablecoin reserves, facilitating payments, and taking deposits. Another quote, we, BPI, note that the potential issuance of a stablecoin by a national trust bank raises complex and highly consequential legal and policy questions that can and should be carefully resolved only after extensive public notice and comment and consultation with other federal banking agencies. Translation, they're saying you should not be able to issue a stablecoin with just a national trust bank charter. And so this is another example of one of the many topics that will be debated extensively during the process of regulations that will be proposed and eventually implemented to enact the Genius Act. Another fundamental question, if you're going to be a stablecoin issuer, can you do that with a national trust bank charter, or do you need a full bank charter to do that? And so these are some examples of the issues that BPI raises in its letters, but it really is a pretty thorough argument that they lay out there in defense of their position that these trust charters are inappropriate for these digital asset companies. It'll be really interesting to see what happens to these applications. I am absolutely certain that we have not seen the last of this ongoing debate.
Well, what they're really saying is we want to control the space and keep you crypto native competitors out of here, which is funny because the irony is that the Genius Act was designed to create clear regulatory frameworks and encourage responsible participation. But instead, what we're seeing is it's become a weapon for the incumbents really to block new entrants into the market.
Let me give you one more quote here that I found from one of the letters. Just as the OCC should not, parentheses, and we offer never would, grant a national trust bank charter to an institution solely focused on, for example, the subprime mortgage market, the OCC should not grant a charter to an institution solely focused on the digital asset market. And so they're effectively comparing the digital asset market to the subprime mortgage market, which might be a little bit unfair of a comparison.
We're going to continue to see a lot of stuff around there. Like you said, we haven't heard the last of it. We're going to have lots of debates about it. I'm just happy that we're having debates about it now versus just managing it through regulatory enforcement. That, to me, is a major step forward that we've seen just in the last couple of years.
The banking sector has every right to voice its concerns over OCC charter applications, the Genius Act, whatever it might be. Those concerns are made public. The responses from the digital asset sector will be made public. And then ultimately, U.S. Department of the Treasury and the OCC will make decisions based on the public input as they issue regulations. And that's the way that the regulatory notice and comment process is supposed to happen. And so this is all a very positive sign, and a sign that the law is embracing the process, figuring out how we treat some of these new digital asset products.
It still feels like the regulatory landscape is forcing companies to pick a side. You're either trying to work within the existing systems or you're trying to follow the regulatory guidelines of the Genius Act. You're getting blocked there. Or you just say, we'll do what Tether's doing for USDT and we're going to operate everywhere else but here. Now, mind you, they're using USAT that's coming up, but that one, I just have this feeling that it's not going to have as much impact, but that is my perspective and my perspective alone.
There's a middle path here that's being overlooked. And that middle path is what's the intersection where traditional financial institutions and crypto native firms can collaborate and work together to bring solutions to market. The M&A activity that we mentioned is one example of that. Another example, one of the messages that I give to banks these days is you have to have a stablecoin strategy. So there are a lot of different ways you can approach it, but you can't do nothing. You've got to do something. And it can range anywhere from, on one extreme, we're going to issue our own stablecoin or issue our own stablecoin with a consortium of other banks. On another extreme, all we're going to do is enable or facilitate stablecoin payments through our normal customer user experience. Somewhere in between might be we're going to get involved in custodying reserves for stablecoins, or we're just going to get involved in banking stablecoin-based businesses. But even on the extreme where the most light touch, enabling stablecoin payments for your customers, even there, a bank is going to have to make a make or buy decision where they're either going to create sort of their own infrastructure to support digital wallets, or they're going to have some kind of joint development agreement or vendor agreement with a crypto native firm that will perform that function for them on a white label basis or otherwise. Whatever it is, the bank is going to have to typically work with, or at least will have lots of opportunities to work with digital asset firms to bring banking solutions to market in the stablecoin and digital asset space. That's kind of the middle path that's not getting talked about so much because maybe it's not worthy of all the headlines. That is the path that I think we will see continue to grow on a slow, steady basis as the Genius Act continues to roll out.
The conversation I had earlier today was about something we've talked about in the past, which is the fragmentation, and there having to be some sort of bridge or layer in there that allows that to happen. And I think right now that may be where the BPI is looking at is like, if we don't get our arms around it now, that means that we're going to be either having to pay for technology that connects us to all of these things or build it. And we still haven't figured out how we're going to make enough money to pay for all of that. So if we could just slow it down a little bit, we might be able to figure it out in time. And that's kind of like the thought process that I'm seeing from some of these things, and especially around the stablecoin space. There's a lot of really good cross-border use cases, and I'm starting to see some domestic, whether it's domestic US or domestic Europe, use cases that are really starting to pop up with some good support.
We're going to see legal issues and political issues continue to influence all this stuff, but ultimately the market issues will drive it forward.
Speaking of market issues, I know you and the team over there at Baker Hostetler dove deep into a couple of reports. Which reports did you guys dive into, and what were some of the key things that you pulled out of them?
This month, there were a lot of interesting reports with Q3 data on various parts of the digital asset space. A16Z put out a really interesting report. TRM Labs, a blockchain analytics firm, put out a really good report. And then 2 reports from the DeFi report that covered new data on the Ethereum and Solana networks. So those were a couple of the reports that we blogged on. A couple highlights from those. Stablecoins now comprise 30% of all on-chain crypto transaction volume, which is the highest annual volume to date, quartered in August of 2025. And that reached more than 4 trillion for the year so far, which is an 83% increase from the same period in 2024. So that just shows how fast the stablecoin market has grown in just the last year.
When you see Bitcoin sliding 18% in one day, as we saw this month in October, people don't exit to fiat and completely leave the ecosystem. They're moving their funds to stablecoins so they can get the stability of the dollar with the speed and accessibility of the blockchain, so that when it comes time to leverage and or use that currency, they can really quickly, really easily. And even if they decide that they want to get back in to the market and repurchase some of those coins that they sold off at a lower rate, it's so much easier, it's so much faster, and they're not circling the drain trying to figure out where did all these fees come from.
All right, now get this. Here's another statistic addressing illicit activity. So this is from the TRM Labs report. Between 2024 and 2025, sanctions drove illicit volume growth for non-stablecoin digital assets, while sanctions-related activity in stablecoins fell by 60%. And this indicates a potential shift away from stablecoins for illicit actors who are trying to evade sanctions. What does that tell us? We're seeing with the growth in the stablecoin market, combine that with the retreat from stablecoins by illicit actors. And I think what that shows us is that stablecoins are starting to become sort of this standalone sector of the digital assets market that is going to be highly regulated, highly transparent, while other portions of the digital asset market, including Bitcoin, will continue to be preferred by illicit actors, among the other many, many use cases that they're used for. What the TRM Labs stat and report is showing us is that while stablecoins are growing, they're also becoming less used by illicit activity. And then, of course, that illicit activity has to move somewhere. So it's going to move to other parts of the digital asset market, aka non-stable coins like Bitcoin, Ethereum, and other highly liquid cryptocurrencies.
The number one way to move money for illicit purposes is good old paper fiat currency. Don't think that this is the only way that bad guys move bad money to other bad people. That is not the case. Cash is still king in that area. But one of the things I thought was really interesting as I was diving into this is that Tether is working with the DOJ to freeze and burn illicit USDT. The thing that I've said so many times is that the transparency of the blockchain makes any digital asset harder to use for sanctions evasion or anything else. And stablecoins just turns it up yet another notch, because yes, your name isn't the actual wallet address, but don't question it. Law enforcement can trace these transactions. They're able to see what wallet it went into, what wallet it went out of, how it was moved, when it was moved. Did it go in a circle and end up back in the place it started? All these, that's the really cool thing about the blockchain technology, is that every last little movement is tracked and traced, and it's on the distributed ledger. That narrative about crypto being the enabler of crime, it's getting weaker by the hour.
One of the provisions of the Genius Act requires a stablecoin issuer regulated under Genius to be able to freeze their stablecoins in accordance with a court order. So that's just another example of how the evolution of stablecoins is going to move those assets more and more to a traditional bank deposit that can be frozen, that can be seized.
Most of these are in USD, but they're not just used in the US. And then you also look at all the other digital assets. They're also not only used in the US. What did the reports say about global adoption of all of these digital assets?
Well, the most interesting finding that I saw was from the TRM Labs crypto adoption report, which noted that between January and July of 2025, the top 5 countries for crypto adoption globally in order were India, the United States, Pakistan, the Philippines, and Brazil. And so what does that tell me? Out of those 5 countries, there's only one G7 nation on there. That's the US. All of the other 4 countries that are the top ranked for crypto adoption are emerging market economies. And so that really indicates and shows that this market is much bigger than the US centric issues that we tend to focus on in this podcast. This is a global industry and it's growing fastest in emerging market economies.
I think one of the big things that I took away is the rapid consolidation, plus the amount of investments that are going out. I mean, we are seeing investment in digital assets and consolidation. It's on a tear right now, and I don't see it stopping anytime soon. I just talked to another group today who is doing an announcement at Bitcoin Amsterdam that is not an M&A, but it sure as heck could be really soon. So I think that's going to be a big piece. The other one is the fact that the banks are defending their position. They're seeing the risks. They're seeing the challenges. They're really trying to figure out, how do we not lose our standing? I personally think the only way they're not going to lose our standing is actually to participate. Participate, don't hate, just make it happen. Get the people the money as fast as they want, as cheap as they want, as securely as they want, and you will win. And then my third and final one, in my opinion, in my perspective, right now, stablecoins are showing to be a clear winner and moving forward, and what money is going to be and how making payments are going to happen going forward. When you see a traditional coin market drop and nothing happens to the main stables, that's a big deal. When you see the volumes go through the roof and exceed 2/3 of the card network volume, that's another thing that just kind of pops out. But man, there's just so much stuff on that. Rob, I'd love to understand what your takeaways from October 2025 are.
Takeaway number 1 is that there is a battleground forming between the traditional financial sector and crypto native firms. There's really 2 main battlegrounds now. One is the Genius Act, and the second that has emerged in the last month here are OCC charters. That indicates that traditional banks will continue to resist losing market share to digital asset companies. And I think we'll see both of those battlegrounds continue to evolve and maybe more battlegrounds arise over the next couple months. Second takeaway from me is that we are now seeing the commentary come in on the Genius Act proposed regulations. And in that commentary, you can see clear splits between various parts of the market. Various market actors are focused on different things. Most often, any given commentator, of course, is focused on the part of the market that they're involved in and the issues that are important to them. And so I do think that we will continue to see very different perspectives on the Genius Act regulations as that public comment period continues. And then third, Western Union launching its own stablecoin. That alone, I think, is evidence that the stablecoin market is real and it's here to stay. Western Union, by and large, considered the world's largest money transfer network. And so that company now entering the stablecoin space is my third big takeaway.
November has a lot to live up to. So hopefully it can keep up. Hopefully as we get into the US holiday season that we get a little bit of clarity, maybe a little bit of a slowdown, Rob. Maybe we get a little bit of a break and we can dive into something a little bit deeper. But the pace of the announcements and the changes and the things that are coming out, it makes it so hard to slow down and pick one or two things to hit on. But I think we did a really good job this month of kind of doing a broad stroke across what's going on in the industry in Web3 for October of 2025.
Always lots to talk about, Ted. I really appreciate being on the show. I enjoy it.
Well, folks, that does it for another episode of Web3 with FTC, powered by Fintech Confidential. If this discussion about Web3 got your attention today, that's great, because there's more where that came from. Go ahead and head over to YouTube, Spotify, Apple Podcasts, or wherever you listen, and hit the follow button to get notified every time it happens. And if you want to stay plugged into everything else that we're doing and everything we got going on and everything we're tracking, go over to fintechconfidential.com and sign up. That's where all the deep dives live, as well as future episodes, and you'll be able to learn a lot more. And if you haven't already, go ahead and share this with someone who's serious about where fintech is going And as always, keep moving forward. As we wrap up today's episode, I've got one last thing for you. If you're in the trenches fighting fraud and financial crime, you know it's a complex battlefield. That's where Hawk's AI tools for real-time payment screening, AML, transaction monitoring, and dynamic customer risk rating come into play. These aren't just buzzwords, they're game changers designed to make your compliance more effective and less of a headache. Imagine slashing through false positives with precision and giving your compliance strategy the edge it needs. Head on over to gethawkai.com to sign up for a demo and discover how their platform can revolutionize how you fight fraud and financial crime.
This has been a production of DD3 Media, with all rights reserved. This is provided for informational purposes only. It is not offered or intended to be used as legal, tax, investment, financial, or other advice. We strive to provide accurate and up-to-date information, but will not be responsible for any missing facts or inaccurate information. You comply and understand that you should use any of this information at your own risk. Cryptocurrencies are highly volatile financial assets, so research and make your own financial decisions.